video, I will give you 5 easy steps to confirm that your financial statements are telling you the real story. Many times I have prospective clients tell me something just seems off about my financial reports, but they're just not sure really what it is. If this sounds familiar to you, keep watching. I'm Kristie Van Pay with Prosperity Bookkeeping, and we take the guesswork out of business bookkeeping. I have cleaned up thousands of mistakes over the course of my career, and that's why I started this channel, to prevent you from making the same mistakes and to provide advice on how you can put the bookkeeping process to work in your business. By the way, before we even get into it, I've included a link to a short quiz below that will help you evaluate how your bookkeeper or bookkeeping system is working for your business. I am not naive enough to think that when I send my clients their monthly financial statements each month, that they are just waiting by the computer ready to dive into them. And the reason I'm most commonly given for that is they just simply don't know what they're looking at or what to look for. So without further ado, let's dive into a QuickBooks Online sample company where I will show you 5 easy steps to review your financial reports to make sure that they are on point. So here we are in QuickBooks Online in the sample company, and we're looking at a balance sheet right now. So if you have a bookkeeper who's doing your books, or if you're doing your own books, you might produce a financial statement at the end of the month called the balance sheet. And just in case you aren't sure what a balance sheet is, it's basically a statement of the things you own and the things you owe and the difference between the two. So if you think of a home mortgage, you're thinking of, I bought the house for this amount of money, so the market value of the house is what you own, but I owe a mortgage on that, so that is what you owe, and then the difference is the equity. The balance sheet is no different, it's just for your business. So what we're looking at here is a balance sheet, and we're comparing it, the current period, which is the last day of the current period, what the balances were as of that day, compared to the previous period. And the reason that I like to do this is it helps to see the changes that happened within that period of time. So within the month of March, what exactly happened? So the first thing that I do when I'm reviewing my balance sheet is I'm just doing a quick look down the change column, because that's going to kind of help me see what happened. So what I'm seeing here is that my cash decreased by $1,200. And what I'm seeing here is that my accounts receivable increased by $3,700. So what that means is at the end of February, my customers owed me $1,500, and at the end of March, they owed me $5,200. And then I'm going to go down a bit farther, and I see here that I didn't have any inventory at the end of February, but now I do have inventory. And what you're going to be doing while you're looking at this is just asking yourself, does this make sense? Did I not have inventory at the end of February and now I do? And if the answer is no, then you know that you need to start asking questions or find out, did somebody code something to the wrong account? What happened that is causing this to show up when I don't believe it should be there? And then if we move down a little bit farther, undeposited funds is basically just telling us this is money that we've collected but hasn't been deposited to the bank yet. So we've recorded the payment, but we haven't recorded the deposit into the bank account. And so what this is saying is at the end of February, I had $226 to bring to the bank. At the end of March, I had $2,000 to bring to the bank. Then here it's showing that we purchased an asset. So as of the end of March, we did not own this truck. So we must have purchased a truck during the month of March. You'd want to ask yourself, does that make sense? Did I purchase a truck in the month of March? And if the answer is yes, then it makes sense that there's a balance there now. Moving down to accounts payable, kind of the same as accounts receivable. At the end of February, this is what you owed your vendors. At the end of March, this is what you owed your vendors. This is reflecting the balance on your credit card, whether it increased or decreased. So in this case, the balance increased by $764 throughout the course of the month, or as of the last day of the month, I should say. And then we have some current liabilities. So here what we can see is that we acquired a new loan, probably to help purchase the new truck, which makes complete sense. So we didn't have a loan payment at the end of February, but now we owe $4,000 to a lender. And that's showing that it increased by $4,000. Same thing here, we have a note payable that has come about throughout the month of March. So we didn't have that at the end of February, but now we do as of the end of March. Now, if this were a loan that you had previously, what you would see is the amount of principal that was paid, or that's what you should see. So if you had a loan at the end of February The difference should be the amount of principal that was paid throughout the month. So this balance should be lower because you've paid down your loan. And this amount over here in the change column should be the amount of principal. So one common mistake that people make is that they record the entire loan payment either to an expense account where it doesn't belong, or they record it entirely to the balance sheet account here, this notes payable account, which isn't correct either, because the interest portion should go to an expense account called interest expense, and the principal portion should go to the balance sheet in this notes payable. So what you're looking for is the change in my loan the amount of the principal? And you can confirm that by going into your bank, online banking, or looking at a loan statement to see if that truly is the right number. And then down at the bottom, we just have some equity, basically just looking at the change in net income. So this is saying that at the end of February, the net income for the year was $293.24, and at the end of March, your net income for the year is $16.86. The change is the amount of net income for that particular month. So if we were to look at our profit and loss statement or our income statement, we would see that at the end of March, our profit was $13.93, which is consistent here with what this is telling me, the change. And we should see our year-to-date profit equals $1686.56, which it's going to look a little different, on this report because I have this for a 6-month period rather than a 1-month period. But if we were to change our date range here, and this is a sample company, so I can't guarantee this is going to work, but in real life, this would work. So we see here 1686.56 and 1686.56. So we know that our balance sheet is looking pretty good and it's accurate. The next thing that you want to look at is we saw here that we have an accounts receivable balance, which means that our customers owe us money. So you might want to just take a quick look at your accounts receivable aging report to see who actually owes me the money and how far past due is it. So that would be the accounts receivable report. And you can find all of these reports under, if you're using QuickBooks Online, you can find all of these reports under the reports menu option over here on the left-hand side. And just search for the name of the report. So here we have an accounts receivable aging summary, which is showing us all of the customers that owe us money. And then along the top here, it's showing us how far past the due date these balances are. So we have some people here that are more than 60 days past due, and some that are 31 to 60 days past due, 1 to 30, and then current. But what you're really looking at here is not only who owes you money and making sure you're following up on these to get them collected, but also here that the total matches your balance sheet. So this is saying 5281.52, and that's what it should say over here, and it does. So that means we don't have an issue with our data. That is reporting correctly. Moving on, we're going to also confirm accounts payable, which is down here in your liabilities section. So right here, 1602.67. So I have the accounts payable report up here, 1602.67. That matches and that looks good. Now, one thing that you do want to make sure is that you have your date right. So this report is as of March 31st. And because I'm in a sample company, it just happens to match. But if you were looking at your own books, it probably wouldn't. And that would be because you need to change the date here to match the same date as the balance sheet. So we would have to put 3/31 here, so that we're consistently matching apples to apples. So if we put that in here and run our report, it's also going to shift how far past due some of these are. So we can see that at the end of March, these people were, or these are vendor invoices. So these bills are 1 to 30 days past due, and then these bills are current. The next report that we want to look at is we want to look at a profit and loss report over a period of time by month. And I always like to use maybe a 6-month range just to try to capture as much data as I can. And what I'm looking for here is any category that seems to have an outlier or some sort of an anomaly, and it just doesn't look right to me. So I'm going to change my dates back so that I've got a 6-month period here. And because this is a sample company, also, if you go into this report, there is some little manipulation that you need to do to get it to look like this, and you'd basically just want to come down here. And normally, if you put in a date range like this, it's going to give you total only. So it's going to look like this, but then you can change the columns to display by months, and then you can see them by month. And as I was saying before I digressed a little bit. Because this is a sample company, I don't have any data in October and November, but we're just going to roll with it for right now. So all I'm really doing is I'm looking across to say, okay, does anything look weird or out of place here? And let's see if there's something I can find. But like for instance, well, that's not really necessarily weird. But let's say, for instance, that I was looking at gas and electric, and all along it's been around this, $90 to $115, and then all of a sudden I see a $500 a month. That's going to make me raise an eyebrow and say, what the heck, did something get coded wrong? Or why was my bill so high? Did I miss a couple of payments and then pay the whole thing off? It's just it's prompting you to ask questions that you should be asking to make sure that things are getting put in the right place and that, we have accurate financial statements. So I'm looking here. This is one that miscellaneous. I don't even know why they allow you to create such a category in your bookkeeping. There should really never be any type of a miscellaneous category. If it's important enough to be written off as a business expense, it should have an account. And so miscellaneous is something we just really don't like to see. But in this case, I would want to know, what the heck is miscellaneous? And it's a pretty big amount too. So then you would just click on the amount so that you could see, what was in there. And then you might say, okay, well, masonry is an improvement. Like maybe you're remodeling your office, and an improvement is something that could be something you depreciate over time. So instead of making it an expense, you might want to put that as an asset on your balance sheet as an improvement to the property that you own. So then this would show you, hey, this actually got classified to the wrong place. And then here we have an insurance payment. Well, insurance doesn't belong in miscellaneous. I'm sure there's an insurance category. So then we know that this was misclassified, and we could just click on it then and put it to the right place. And I would assume insurance is in here. Yes, it is. So we would just reclassify that to insurance. So that is the purpose of looking at the profit and loss over a period of time so that you can kind of see, okay, this month something looks out of whack. It just doesn't look like the pattern I'm used to seeing. I've given you 5 easy ways to review your financial statements, but if you want to know more about whether or not your business has a solid bookkeeping system in place, click the link below to take the short quiz. If you found this video helpful, please give it a thumbs up, and if you haven't already done so, subscribe to the channel. Comment below, how often do you look at your financial statements? Thank you for watching, and see you next time.